Hi, in this video we'll be looking at another source of risk in financial assets, and this will be exchange rate risk. So what is exchange rate risk? Well, if an investor holds foreign investments, returns will be affected by how the domestic currency fluctuates against the foreign currency. So we're only really interested in foreign investments here, and we're obviously looking at how our exchange rate is going to change, hence the name exchange rate risk. And this should make a bit more sense when we look through an example shortly. But what we're effectively saying is that if our domestic currency increases in value, this will erode the returns on foreign investments. So if, for example, if we are based in the UK, we only really care about our returns in pounds sterling because that is our domestic currency. And if we invest in a different currency, well, it's going to matter what the exchange rate is between these two currencies in order to be able to calculate the actual return we've made on our investment. But let's run through an example so this hopefully makes a little bit more sense. So, as I've just mentioned, let's assume that we are based in the UK and we're investing in a bond in the United States. So the principal of this bond is going to be $1,000 and the bond pays 10% interest in dollars. So there should be a bracket there. So obviously because it's a US bond, it pays interest in US currency, which is dollars. And that's the key factor that we're interested in here because I'm a UK investor. I generally use pounds to buy goods and services, but the bond is going to be paying me in dollars. So just for simplicity, let's initially assume that the dollar to pound exchange rate is 1-to-1. So £1 is equal to $1. Obviously this isn't the case in reality, but it helps just run through this example. So if I have invested £1,000 in this bond, it has a principal of it is £1,000, but I've invested $1,000, shall we say, then the bond is going to pay me 10% interest. So I receive $100. And because of the exchange rate is 1-to-1, $100 is just equal to £100 because a pound and a dollar are exactly the same because we have a 1-to-1 exchange rate. So that's easy enough. However, let's consider that the pound increases in value and we have a change in our exchange rate. And again, for simplicity, let's say that the dollar to pound exchange rate is 1 to 0.5, so the pound just doubles in value. And this again is a bit of an over-exaggeration. We won't tend to see this happening, but it should just help to illustrate our point. So our bond in the US is still going to be paying this 10% interest rate, and it's still going to pay $100. However, this is now only worth £50 because our exchange rate has changed. The pound is worth double, so £1 is equal to $2 if we look at our new exchange rate. So we're still receiving $100, but we can only exchange this for £50. So the returns on this investment have halved purely because of the change in the exchange rate. And that is basically all there is to exchange rate risk, and this will not really matter for investments within our domestic economy because we're not having to exchange money, but any foreign investment we're going to have to consider this because we will be investing in a bond in a different currency, and so if our domestic currency fluctuates against this, this is going to have an impact on our returns. And there are a few ways that investors can mitigate this risk, i.e. avoid the risk, and this would be to invest in hedged funds, so a hedged ETF, for example. And this is just if you purchase a financial asset that already takes into account the exchange rates, and so it's just already built in and you won't have to worry about prices fluctuating. And I won't go into too much detail as this is just an introductory video. But investors can also use other instruments like currency forwards or futures, and this will help them to hedge against exchange rate risk. And so if their investments were to massively decrease in value due to a change in the exchange rate, they will have other assets which actually hedge against this risk, and those assets would increase in value and the risk would be offset. It is also worth noting that changes in exchange rates can also increase your returns. And in this example, we had our domestic currency appreciating, increasing in value, so the returns were halved. However, if the local currency depreciates against the foreign investment currency, you wouldn't actually want to hedge the risk and your returns would just be increased. So for example, if the pound halved in value, so our exchange rate became 1 to 2, we'd still have this $100 return, but this would be worth £200, and so our returns would actually be doubled in our domestic currency, so that would be great. But as we have discussed in our previous risk videos, we tend to look at the negative side, and if there's an increase in variance, i.e. we could have a positive return or a negative return, investors tend to focus more on the negative aspect. They are risk averse in general, so if there's a risk of the exchange rate changing a lot, they will tend to require a risk premium, i.e. a higher return in order to cover for that risk. So that's a very quick introduction into exchange rate risk. If you found it useful, please do leave a like rating. Make sure to check out the other videos on sources of risk in financial assets, and subscribe to add some econ to your subscription feed.